We do not want this escalation. We do not want a trade dispute with the United States of America. But if we are confronted with tariffs that we consider inappropriate, then we are in a position to respond.
Tariffs should not be used against allies in this way. In relation to the escalation, look, a tariff war is in nobody's interests. And we have not got to that stage, and my focus, therefore, is making sure we don't get to that stage.
This is the first time that an economic instrument, tariffs, which we don't think very highly of, has been used for geopolitical reasons, especially against both adversaries and friends. This is obviously unacceptable.
Transatlantic ties being tested by President Trump's latest tariff threat over Greenland, and markets are speculating whether Europe could respond by weaponizing the trillions of dollars of US stocks and bonds they hold. I'm Paul Allen in Sydney. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, treasuries fall and stocks pull back as Trump's Greenland-related tariff threats test market confidence after a rally fueled by investments in AI. To assess the market fears over transatlantic ties and Japan's tax cut, we'll be joined by Barclays head of FX and EM macro strategy in Asia, Mitul Kotecha. And we'll have a great lineup of interviews from Davos as well, from IMF's managing director to the CEO of India's Axis Bank on how they're viewing the risks. German Chancellor Friedrich Merz says he's trying to persuade French President Emmanuel Macron to tone down his response to President Trump's threat to impose new trade tariffs on European allies. Macron is said to be eyeing the activation of the European Union's anti-coercion instrument, but German Finance Minister Lars Klingbeil is still urging European leaders to stand up to Trump's threats.
We are constantly experiencing new provocations. We are constantly experiencing new antagonism, which President Trump is seeking, and we Europeans must make it clear that the limit has been reached. All of this shows what a period of upheaval we are currently living in. The logical consequence for me is very clear. We must make Europe stronger. We must do so much faster than is currently the case.
Well, let's bring in Bloomberg editor Balazs Pens in Hong Kong with more on this. So, Balazs, tell us a bit more about the anti-coercion instrument. How would it be used? Why is France keen on possibly using it and Germany less so?
Well, yes, Paul, we see what seems like a range of emotions in the responses from the European leaders. We saw the French and the German finance ministers coming out pretty strongly in response to the tariff threat from Trump. We saw Starmer and Merz being a little less sort of bellicose in their response. This instrument that you mentioned would be sort of like a nuclear option for Europe. This is the strongest economic response Europe might be able to give, and this kind of transports us back in time a little bit to before we had the trade agreement between the U.S. and the EU, where we had these threats of tit-for-tat escalating tariffs. That kind of conjures up that image, that possibility. Now, clearly, the reactions from the different countries depend somewhat on their own economic situations, their own exposure to U.S. trade. So that's why we see a difference between the response from France, Emmanuel Macron, and Germany, Chancellor Merz. But the question is how the Europeans can come together and how they can decide how to deal with this latest tariff threat from Trump. Their experience is that there have been instances where they were able to manage Trump, and the sort of initial threats were toned down, and they were able to kind of get to a place where they both felt comfortable with the outcome. But this does seem to be a little bit different, so there's a lot they need to talk about in Davos this week.
Yeah, well, the anti-coercion instrument is perhaps at the extreme end of the continuum. There might be a range of other options as well, and certainly there seems to be agreement among Europe that backing down is not one of the options. So what other measures could we potentially see from Europe?
Well, I think for right now, they are still looking to manage. They're trying to use diplomacy. They're trying to use the opportunity that they have in Davos to sort of talk head to head and see eye to eye on this issue. As we've seen earlier, whether it was the case of the earlier tariff negotiations or whether it was in the case of Ukraine, they were able to kind of get Trump to back down a little bit from some of his initial demands, some of his initial threats. So right now they're using diplomacy as the main option, and this is what Chancellor Merz was alluding to, that they think that there's still an opportunity to kind of talk this out and kind of take some of the rougher edges off of this.
All right, Bloomberg Deputy Managing Editor Balazs Pens there. Well, IMF Managing Director Kristalina Georgieva says the global economy's held up well despite mounting challenges. She spoke to Bloomberg at the World Economic Forum in Davos.
Well, let's start with the good news that the world economy has proven to be remarkably resilient. We are projecting 3.3% growth for this year. We expect 3.2% next year. And when we look at the sources of this resilience, 4 things stand up. 1, trade tensions have not been as dramatic as we feared. Yeah. 2, private sector, incredibly agile. Yeah. 3, and we don't talk enough about it, good policies. The fact that governments have developed tools to act responsibly for AI and the promise it holds. So your question is correct. Would this resilience hold? Too early to say what exactly the impacts of new trade tensions is, but we know that when we have more uncertainty, bad for business, bad for households.
But MD, does this feel different? Because this is something over Greenland, so this touches sovereignty. In 2025, what held the economy together is that not many countries retaliated. This could be different.
Well, we shall see. I would not venture into speculations what is going to happen or not happen. What I would say is that it is very important that we recognize we are in a world of unthinkable happening. And in this world, I have one advice to people: stay calm, assess with no emotion where you might want to go.
How difficult is it to assess the impact on the economy if we do have these extra 10% tariffs on certain European countries? Who would lose?
We have run all kinds of simulations of what may happen. And what we do see in this simulation is that we deviate from keeping trade more or less on the right track. That could halt growth down. What I want to stress is that the best way forward, find a path to agreement. And that is going to be good for everybody everywhere.
I mean, there's, again, quite a lot of, I guess, concern on the ground as President Trump arrives here that they've already left 70 international institutions. Are you worried that they could eventually leave the IMF?
To be very frank, no. I think we are great institution for the members, 191 of them, including the United States. So let me give you 2 reasons why I'm not worried. Number 1, we cost no money. We actually work like a savings account. The US lends money through us. We pay back with interest. For the last 2 years, the US got $3.1 billion in interest from the on-lending they do with us. Number 2, we actually are strictly focused on the economy and on reforms. And that is great for everybody's business, including for the US. And there is no other institution, when there is fire, we come and we put it down. And when you look at the world today, Francine, do you know how many fires we are putting down?
Many.
50. We have 50 programs. And of course, our determination is to continue to serve the membership, to be good for business, to be good for households.
That's IMF Managing Director Kristalina Georgieva there, speaking with our colleague Francine Lacroix in Davos. Well, let's get some more on how the latest developments are playing out with Hebe Chen, analyst at Vantage Markets. Hebe, thanks so much for joining us today. And I do want to start, obviously, with all the posturing going on over Greenland at the moment. But I'm curious about what it means for implications for markets. Do you think we're seeing a resumption of the sell America trade? We've got a weaker US dollar, and is perhaps the scene being set for one of these taco moments? Trump always chickens out.
Hi, Paul. Thank you for having me. Yes, I think you mentioned about the couple of things that we seems to not unfamiliar with. We have experienced that fully in 2025. And what I've seen, the market seems to taking a very risk-off positions to this newly development in the tariffs. We all know that tariff is in the news. It's about that the target that Trump trying to achieve, and for the market is that the key message is this tariffs risk as well, trade risk isn't going anywhere. And on the surface, we do think the market seems to be pretty resilient for the second half of 2025, and it seems like the tariffs is not a risk to the market yet. But I think this time, what the response to the market, including the stock market's down, the US dollar's down, the precious metal, gold, silver price push up to all-time high. It's a very strong message just saying that the market is not yet to get over with that. Instead, the anxiety and the uncertainty that's actually building up, and that will potentially becoming the background for all the markets operate into 2026.
What do you feel the chances are of the European Union using that so-called anti-coercion instrument? And were it used, what would the market implications be?
Well, I think that not even saying that apply the ACI, even they talk about ACI, the threat of ACI is already quite a big step. It seems to be open the door that regardless what could sort of a tool in the toolbox they could potentially apply, including the restriction to the investments, in restriction of the market entry, they will have quite profound impact. The impact is not just for the US market, but also for the EU market and even broader for the global market. So I think talking about that, the threat of that is already opening up the door and opening up the key source for the market to be quite cautious about what could potentially come in. And that given that Trump is setting up a deadline for June, and we know that as you talk about the tackle, whether or not that could potentially happen this time, I think that will definitely keeping the market to keep guessing, and also that things changing back and forth will be another source of the uncertainty and volatilities for all the markets.
Well, it's not just the ACI that could be a factor here. I mean, we've heard from the Deutsche Bank chief currency specialist talking about the possibility of weaponizing capital. Where would you place the risk of a coordinated sell-off of US assets? And, of course, this is something we've seen before on Liberation Day when the bond market got, in President Trump's words, yippee. He backed down on tariffs. Could we see that happen again in this case?
Well, I think likely in the way that it's not just about the short term, as we mentioned, that if the ACI really open, the door is really officially open, that would mean the trade relationship between EU and US were definitely getting into the totally different stages. And that impacting would be fundamentally fit into the US economy as well, because EU is quite a critical trade partner for the US economy. So from that base of point of view, that means that fundamentally we will have a big significant risk to the U.S. economy. And that will make another reason, as you mentioned, about the sales, U.S. assets. And we already see a bit of earlier sign that has surfaced in the late 2025. If you compare the U.S. stock performance compared to the non-U.S. stock performance, we're already seeing that the U.S., for quite a rare cases, is underperforming. And from that perspective, what we can sense a little bit of the demand for looking for alternative, given such a high risk is now accumulated in this country and all the asset related.
Another US asset not doing particularly well at the moment is the US dollar. It's had its worst day in 2 months. What's your outlook for the greenback?
Yeah, that's a very interesting point, because when you're looking, like last year, we're talking about tariffs. We're talking about what sort of inflation implication from tariff. If that's the case, they're putting extra tariffs to the EU, they will potentially push out the US inflation. And that's supposed to translate to a higher US dollar. But that's not the case, as you mentioned, that we've seen for the past 2 days. So I think that message to me is that the market now looking at tariffs has passed on the inflation implication, but rather on the trade risk, rather on a more structural and systemic risk. So that's the reason that underpin the weakness of the US dollar. So if that continues to be the case, the tensions there continue to drive the market, I would expect a further lower down for the US dollar.
Well, you mentioned a moment ago that US markets have been underperforming relative to Asian markets. Do you anticipate this trend to continue? If you're putting money to work right now, where do you go?
Well, yes, if you just from the number point of view, U.S. market up about 16% last year. But if you calculate into the currency risk, the U.S. dollar versus many Asian currencies actually down. So if you put in the math all together, in the 2025, you purely put in the U.S. market will actually underperform quite significantly if you put in on the Asian market. Whether or not I expect this trend to continue, I think it's very likely because capital is always looking for the smart way. So I would expect this sort of diversification, either from the risk point of view, from the region point of view, from sector point of view, will continue to spin up and continue to fit into the markets that probably will expose less risk of that. I think Asian market, given that it's kind of quite resilient in terms of economy fundamental, will continue to benefit in this year.
So from a sector point of view, what do you like at the moment? I mean, defence stocks have been performing well. Do you see the tech story in Asia continuing, or is there something else that you favour at the moment?
Well, yes, defence and defensive, they both are will be, I think, the top beneficiary for this year, given this unsettled and the anxiety here. For the tech sector, I still fairly believe in the potential for the AI technology, even that there's a doubt about the AI bubble. But what I'm seeing is that fundamentally, if we're looking back for the past 3 years, we know that now we have no doubt that AI is changing the world, it's changing the way we live and the way we work. So any applications or the infrastructure beneath that I would expect the demand will only going up rather than down. It's just to the time that we'll probably have to be more picky about that way we pick. Just be more picky about that in what positions these particular companies that is standing in this sector. So overall, all the sectors you mentioned, defense, defensive, technologies will still be on top of my mind.
All right, Hebe Chen from Vantage Markets is sticking around. And when we come back, we're going to turn our focus to Japanese markets as Prime Minister Takaichi calls an early election. This is Bloomberg.
Prime Minister, today I have decided to dissolve the House of Representatives on 23rd January. After dissolving the House of Representatives on 23rd January, the campaigning will start on 27th January, followed by the general election, which will be held on February 8th. I plan to hold the election immediately as such. I, myself, am staking my career as Prime Minister.
That's Japanese Prime Minister Takaichi announcing her plans to hold a snap election next month. Hebe Chen, market analyst at Vantage Markets, is still with us. And Hebe, I want to start by talking about some of the action that we've seen with Japanese bonds. And of course, we've got a 20-year auction. We'll have the result of that pretty soon as well. But we've got yields rising now across the curve. Even the 40 years at 4% now. It's the first time it's reached that level since its 2007 debut. So where are yields heading from here? And does this look normal to you?
Well, it's definitely not normal when you get into such a high level, and you can see that this curve, as you're showing on the screen, is quite a steep curve here. Well, I think any extreme number showing that the level of the market's expectation, and especially you mentioned about the ultra long one, the 40-year one, I think that just surfaces about what the market looks for the longer term outlook for the Japan's, for example, all the issues we talk about, the debt sustainability, the health of the government's financial balance sheet. I think they're all showing that the market do have quite serious concern about that. And the reason that has been triggered by the announcement of election, it seems to be that the information or the market takeaway from that is that all the issues is not going to resolve with the current governments. And if they're trying to push too hard to the easy money to support the growth without looking at the existing issues, that will be a big problem here.
Well, of course, the rationale for Prime Minister Takaichi calling this election is to strengthen her mandate, and this is part of the reason we're seeing this action on markets, of course. But Is there a risk here that doesn't play out as expected because there is a new centrist party now on the block, and as we've seen with a number of other elections in developed markets, things don't always turn out the way you think?
Well, I think Mrs. Takaichi, as she played there, that she make a very strong bold saying that I'm putting my career at risk here. I think given that since that Mrs. Takaichi took the top office, we do have seen a lot of things has changed, especially in terms of the support level that for the current prime minister is getting into a very high level. I think, remember, above 60%, which is quite unusual for the Japan's politics landscape. That's a positive side. But on the other hand, that will potentially give her more confidence to push up more aggressively without considering the real issues. For example, as we mentioned, the debt sustainability. So what the market taking these new policies of the cutting the sales tax is that they not just trying to fill the gap of the sky-high debt, instead they're trying to dig an even deeper hole to making this debt pool even larger, and probably will get into the level for the government that incapable to fill that. I think that's the key message the market takes and market most concerned about.
And you see what's happening on the political scene and with the pickup in yields as well. Is this going to complicate the path at all for the Bank of Japan? I mean, we're not expecting any change this week, but how about the tightening path further down the track?
Well, yes, definitely. Apart from the yields, we also having the Japanese currency is now getting to the lowest levels from the July 2024. The USD versus JPY is now getting to 159. So, which making the policy runway for the Bank of Japan is very complicated. On the one hand, the inflation, we talk about that, it's getting into the fourth straight year of above the target, meaning that they do have to do something to keeping the policies restrictive. But on the other hand, it's a market that we're having a quite volatile and very, very sensitive yield and currency markets. So we're making that any missed message coming from this Friday. Yeah, as you mentioned, there's no expectation for them to make change. But what the market will digest very, very carefully is what sort of message about when. It's not about whether or not they will keep hiking, about when. So the market, the Bank of Japan do have to be very careful about the language that it chooses to convince the market to stabilize the currency market as well as the bond market.
Hebe, you've got about 60 seconds left, but I want to quickly ask you about Korea as well. We've seen an everything rally, the Kospi rallying hard, taking a bit of a breather today. Just very briefly, 1 minute, does this look frothy to you?
Well, yes, the Korean market is the best top performer for the Asian market last year, and it coming from good reasons. One is the confidence in the local asset, and another one is the confidence in the economy as well. I think if they turns out all these two fundamental views has been come to more significant into the year, but I think I still feel confidence about that. But for the Korean market, there's always a governance issues that will always underpin that the potentially trigger some of the
Hebe, we're having a little bit of trouble with your audio there, so we might have to leave it there, unfortunately. But thank you so much for joining us today with your analysis. That is Hebe Chen from Vantage Markets. And we have plenty more ahead. We'll bring you the latest from Davos as well. This is Bloomberg. Welcome back. You're watching Insight. Here's a quick look at where markets stand as mainland Chinese markets head to lunch and Japan comes back online. It's mostly a risk-off day for markets in Asia. President Trump's tariff threats over Greenland reigniting trade tensions. We'll be watching for the results of Japan's 20-year JGB auction. That's coming up in a couple of minutes. And this is after the 40-year yield hit a 4% threshold for the first time since its debut way back in 2007. Borrowing costs are rising amid growing unease over Prime Minister Takaichi's spending plans. Now, we're also tracking moves in the Indonesian Rupiah, hitting a record low today. Now, President Prabowo Subianto's move to nominate his nephew for a Bank Indonesia deputy governor position is renewing concerns about the independence of the nation's central bank. Well, staying on Southeast Asia, Malaysia's sovereign wealth fund chief expects the ringgit to strengthen further, building on its run as Asia's top currency last year. Khazanah National Managing Director Amirul Feisal Wan Zahir spoke with us from Davos about the FX outlook and Malaysia's push to develop rare earths.
when you actually look at what's powering the economic growth, I mean, the GDP is actually quite stable. In fact, when you actually look at it, people are not just looking at growth, people are looking at stability and predictability. So I guess as far as the country is concerned, if they actually show execution, if they actually show stability of policy and the momentum actually going pretty well, I think you're going to see that continue much longer.
The continued chaos in the world, in the developed world in particular, benefiting emerging markets like Malaysia.
Well, I think now the scarcity of a product here is stability rather than anything, right? So, yeah.
So where do you see the KLCI going? How much more upside from here? And when it comes to the currency, can it strengthen further?
Well, as far as KLCI is concerned, I think there's a role to play for people like us, capital investors. We can be active market players to see it grow further. We've seen that in Japan, we've seen that in Korea, where if we actually try to be a bit more active and trying to get the companies to improve their ROEs and profitability and earnings, I think there's more room to grow.
And for the ringgit?
The ringgit, I think we'll see a bit more strengthening, and really looks at the US dollar, and I think the outlook as US dollar would reduce.
Come on, look into the crystal ball. Give us some projections for the end of 2026. Where do you see the ringgit headed towards?
I'd like to quote some of the analysts, and they're looking at 4, or even depending below 4. But yeah.
Of course, there are lots of headwinds right here in the world today. We talk about how they are shifting alliances and geopolitical tensions are rising. How might that play out when it comes to emerging markets like Malaysia, considering the fact that when there is volatility, when there is a surprise, investors tend to make an exit from EMs first?
Well, I think you're right. I think emerging markets tend to have capital coming in and out fast, and that's why you see that. But I think people have to look at the fundamentals. Like I said before, what is scarce today is that stability. And when you look at emerging markets, especially in Asia, that continued growth about 4 to 5% across all the countries, and you can see the demographics, which is a lot younger. So you do see that long earnings growth going forward. So I think from that perspective, I think it's a good market to be in. Yeah.
What's your strategy for 2026? We know that you're 90% equities, 10% real assets. Any reason to make shifts?
At the moment, I think what we try to do is we follow developed markets. So, for example, we try to hug the beta for developed markets. Emerging markets, we have that as well. Being a sovereign wealth fund for the country, we're about 60% in Malaysia. And for that, I think it tends to be a bit more strategic. And what we are looking at are the ones where it could actually benefit from all this reconfiguration of the market. And that is looking at policy changes when it comes to semiconductor supply chain, infrastructure to capture growth within the region, whether it's connectivity, energy transition, as well as digital.
What's especially attractive this year that's different from the last maybe 12, 24 months?
I think what is attractive is with all this chaos that you see, people are trying to look at markets in order to get that stability. A weakening of ringgit, so people are looking at metals, looking at hard assets, looking at anything which might benefit from policy changes that countries are doing as a result of this change.
We know that Malaysia wants to be a big player in rare earths. We have the Prime Minister saying that it wants Khazanah to lead in terms of the projects and ventures. Where are you with that?
Well, first of all, that is correct. That's something we're looking at. But I think I mentioned to you this last time, it takes time to really understand the reserves available that can actually be accessed. Because a lot of the rare earth minerals are in protected forests, for example. And of course, the environmental impact needs to be looked at. And that is something which the country is currently looking at.
Are you in conversations with China? Because there are talks about joint ventures.
We're open with speaking to anyone.
What is the goal in the end? It's going to take time. Say in 5 years, where do you see Malaysia in this rare earth space?
Look at the country, for example, right? Now, the country has this concept where, from a trade perspective, it's a critical part of the world's supply chain, and it has to be neutral or central to trade, and as well as to supply chains. So it has to have, work well with China, work well with the US, work well with the rest of the world. And I think what we'd like to see is, at least for this rare minerals, is for there to be trade with all countries.
Faisal, just one final question. I mean, we're talking about shifting alliances and uncertainties. What's top of mind for, CEOs like yourself here in Davos?
Well, looking at where the momentum is really going, I think the underlying current is important to identify and know. We have seen geopolitical changes like Liberation Day, even in Venezuela, but markets either have come back or not reacted. And so identifying that momentum.
That's Khazanah National Managing Director Amiral Feisal Zahir speaking with Insight anchor Haslinda Amin in Davos. Let's check in on how stocks in Vietnam are performing. The Vindex had a really good year last year. It was up by more than 52%. It's kind of flat today, although we're seeing a similar trend across all major markets at the moment. Vingroup losing a little ground there, off about 3%. The Vietnamese dong stable against the US dollar has been all year. But we are watching Vietnam because it is the party's national congress at the moment. We have heard from the General Secretary, To Lam. He's been laying out his vision. He's calling for a new model for the country to reach its 10% growth goal. Also a focus on technology, private industries, and a plan to root out corruption as he wants to lift GDP per capita to about $8,500 US. Let's get more now out from our Hanoi Bureau Chief, Francisca Stevens. So, Francisca, walk us through what's happening this week.
Yeah, that's right. Party Chief To Lam has been addressing delegates at the opening ceremony for the 14th National Congress in Hanoi, and you just laid out some of the key headlines from his speech this morning. He's been talking about the need to form a new model for growth, and he also sees room for faster and sustainable growth. He also reiterated the target of at least 10% growth for this and the next few years, highlighting the role of tech development. Now, To Lam is aiming to secure a full 5-year term in the top job at this Congress, and he may also be put forward for the presidency, which would represent a major political victory for him. Over the next few days, we'll see just under 1,600 party members vote for the Central Committee, which in turn will select the Politburo, and from that, the General Secretary. They'll then make nominations for the top government positions, so that's the likes of the Prime Minister and the President. We'll find out who has secured the party chief position later this week, and it will be a big surprise if it's not Lam. What's less clear at this stage is if he will also secure the nomination for the presidency. We may not find this out until after the Congress, though.
So if things play out as you've described and To Lam becomes even more powerful than he is now, what's he going to do with this power? What's he trying to achieve?
So in the roughly 18 months that he's been in the top job since the death of the former party chief, To Lam has pushed through some of the biggest reforms in 40 years, slashing the size of the bureaucracy, shrinking the number of provinces by half, and cutting a tier of local government. Thousands of bureaucrats have lost their jobs in the process, and this will be a chance for him to secure the backing for his mandate and keep on that reform path. Delegates are also going to sign off on a new 5-year development plan for the nation, and while we don't expect there will be much divergence from the current policies, we will be looking closely at the language when it comes to the private sector and spurring growth, and whether Vietnam will give that backing to To Lam's policies to spur growth even further. The Congress comes at a crucial time for Vietnam, still negotiating that tariff deal with the US while balancing relations with China. So plenty to watch out for as this week unfolds. It runs through to Sunday, but we could get an announcement as early as Saturday.
All right, Vietnam Bureau Chief Francisca Stevens there. Now let's get you to a story that we have been watching. It is the Japan 20-year bond auction results. So let's get you across the results. We saw a weaker demand than the 12-month average. The bid cover ratio, 3.19. That's compared with 4.1 at the last auction. The 12-month average is 3.34. So the bid to cover ratio is somewhat weaker than what we've become accustomed to. We see the intraday yield holding pretty steady there at 3.356 at the moment. But this weaker demand partly due to government plans for tax relief on food. We've seen yields rising across the curve. And of course, Sanae Takaichi, the Prime Minister, officially calling that election today is going to be held on February the 8th, gambling that she's going to be able to increase her mandate. Still to come. Axis Bank CEO Amitabh Chaudhry is going to explain how India can support economic growth as consolidation gathers pace across the financial sector. That conversation from Davos up next. This is Bloomberg. Welcome back. You're watching Insights. Here's a look at Indian markets just ahead of the open. We are anticipating a little bit of weakness, but of course we're seeing a little bit of weakness everywhere. We of course, have this backdrop of tension between the US and Europe over Greenland, but the pre-market India, things are looking pretty flat at the moment. Nifty futures off by about a little more than 1/10%. Well, investors say, meanwhile, India's central bank's going to need to pump significantly more liquidity into the banking system, with rate cuts and record debt purchases not enough to bring yields down. Let's bring in senior FX and rates reporter Subhadeep Sarkar in Mumbai. So, Subhadeep, why has the transmission of RBI policy actions to bond yields been muted, especially at the long end?
Hi, Paul. The transmission or the lack of transmission of policy rate cuts and policy actions to the bond yields is a major talking point in the Indian bond market. Since in 2024, we have seen roughly about $160 billion worth of liquidity infusion by the central bank through open market bond purchases and forex swaps and cash reserve ratio cuts, as well as about 125 basis points of policy rate cuts. Despite the massive easing, the bond markets, especially at the longer end, have hardly budged. Some of the longer yields are actually at levels we saw before the easing cycle began, and while some of the 30-year and odd bonds are actually, the yields are trading higher. That has also percolated down to the corporate bond market, where we've seen longer yields have moved higher. Shorter yields have reacted better last year to the policy cuts, but again, some of the shorter yields, like certificates of deposits, which banks use to raise short-term cash, have again started inching up since the last quarter. So that is a worrying signal for the central bank, because the central bank wants to kind of see its rate cuts pass through.
All right, that's Bloomberg senior FX rates reporter Subhadeep Sarkar there. Well, India's Axis Bank says it sees a wave of consolidation coming to the country's lending sector. CEO Amitabh Chaudhry spoke to us at the WEF in Davos, sharing his outlook on the industry and government efforts to prop up the rupee.
So many of these deals are happening, and they're coming in, investing in some of the mid-sized players in the country. So it obviously clearly indicates that they find the Indian market attractive. They like the GDP growth rate. When they look at their markets, they believe they can make those returns. And it's good for the banks where this investment has happened, because it gives them staying power. They have foreign brands backing them, and so on and so forth. The only issue I have with this is that banks are the most leveraged institutions in the world, and the only way for them to really grow is to be able to get the deposits in. And getting deposits in India is not the easiest of things. Your local brand, local presence, local depth matters, and that will take a long time. So each of these investors who come into India, I'm sure, have a very, very long-term view, and they do need that long-term view to be able to leverage the capital they're infusing in these entities completely.
We'll pick up on deposits just slightly later. I'm just wondering, in terms of these deals, how many more are you looking at? How big are they likely to be? What does it mean in terms of competition for you?
So, well, I mean, obviously the reason these banks are coming in is because they believe they can add value to the institutions they have invested in, and it could lead to increased competition. We are also hearing about merger of public sector banks to make them bigger and larger. There's also one or two divestments being talked about by the government, and again, some foreign players and some local players have shown interest. So the competition is intensifying. I mean, by the way, there's enough competitive intensity anyway. So we are all generally well prepared for it. I do believe that one or two of these institutions will be able to come out from that mid-size bracket and give competition to some of the larger banks. I think there are in India today only 5 or 6 banks who can cater to every requirement of a customer across the entire value chain. India, given the size of the economy, given the ambitions of the government, does need many more banks. So competition is welcome. Competitive intensity is high. It might increase a little bit. Not that I should say it does not bother us, but we are well prepared for it.
Consolidation, is that expected? We know that the RBI, the government, they pretty much want the big banks to consolidate further. Where are we with that?
So consolidation will happen. The problem is that the ones you want to consolidate don't want to be consolidated. The ones who are not worth buying are the ones which are available for sale. But I think over a period of time, as disproportionate share of profits continue to remain with the larger institutions, I think some of the banks might be forced to look at the strategy all over again. You're seeing that in other parts of of the markets also. It's not that banking is the only one. So I would expect consolidation to remain a theme for a long period of time. Now, how many happen, how many go through with whom, only time will tell.
How many? What is the right number?
I think, obviously we have a large number of banks, but India does need, in my mind, at least 8 to 10 large institutions to support the economy who can, as I said, play across the entire product suite. Right now, we don't have that.
So the small banks are at risk. Fair assumption?
Either they decide to stay small and just cater to a certain section of the population or a certain product suite. If they want to be large, if they want to play across the entire spectrum, they need to be much larger than where they are today.
So right now, deposits, a huge problem for Indian banks. Why is that? Is it a case of, retail, I guess the mom and pops, they're putting their money basically in the equities market. Is that it? They're propping up the equities markets in a huge way.
So, that money which the small investors are putting in, it does come back. The nature of the deposit changes, but the money remains in the deposit system. The problem is not that. The problem is that initially RBI had curbed liquidity quite a bit, which obviously played into the low growth of deposits. Government is also carrying a lot of surplus balances, so that money is not in the economy. Also, RBI had infused a lot of cash in the system. So when you look at all of that, the basic flow of money to the deposit system, the banking deposit system, has definitely slowed down. RBI has stated openly that they would like to maintain certain durable liquidity in the system. We have seen times when that has not been possible because RBI has intervened in the foreign currency market, so liquidity has got kind of sucked out a little bit. But the expectation is that RBI will stick to its stated stance and bring durable liquidity in the market. That should help in deposit growth. But if on the credit side, the expectation is that the Indian credit growth will be 15 to 17%, ultimately deposit growth also should be a similar number. It cannot be different. And I think we are still some distance away from it.
So when realistically can we see that pick up?
I think it's another, in my mind, and I'm just throwing it out here, 18 to 24 months is the minimum time required for deposit growth to come back, and that will require sustained intervention by RBI in terms of ensuring that the durable liquidity remains and this deposit growth continues to move forward. Another thing which is happening in India is that, obviously, as I said, nature of deposits changing. So the cost of funds overall for the system is rising because the wholesale deposits tend to come at a higher price than...
It doesn't help that the RBI cut rates 4 times at 125 basis points. That is part of the reason why you're having trouble with deposits.
Yes. Obviously, we have not been able to pass on the entire cut on the reverse repo side in form of deposits, while the interest rates on the lending side have definitely kind of come off a little bit. So you have seen squeezing of net interest margins of various institutions. I think it is stabilizing now. Hopefully from here on, assuming no further interest rate cuts happen, the net interest margins will start stabilizing or start moving up. Please understand that RBI also has institutionalized that if they cut interest rates, they need to be passed on to the customers very, very quickly. So all of us, literally within the quarter in which the interest rate cut is announced, have to pass it on to the customers. In our case, the number is 60 to 65% cuts happen immediately.
Amitabh, I want to talk about the rupee, the Indian rupee, among the worst performers in Asia. In fact, it was the worst performer in 2025. Is that a reflection of the economy? And how can it be so weak when the economy is growing at 7.5% to 8%?
That is reflected in our stock markets also. We're one of the worst performing stock markets. So yes, I think it's just reality on the ground. If you look at the net FDI inflow, it was close to zero. Gross was 1%. An economy which expects to grow anywhere between 7 to 8%. The net foreign direct investment should be in 3 to 4% range. We are still far away from it. I think the investors generally have moved away from India. They have gone to China and some of the other markets. I think there is a belief somewhere that maybe on the AI side, India has got left behind a little bit. Government is fully cognizant of that fact. So you have seen constraints being removed on fiscal, monetary side and the regulatory side. Government has formed various committees. You have seen some reforms which were not even thought were possible earlier. So I would say that the government realizes that they have a bit of a problem in their hands. I think very, very focused on trying to see as to how they can remove some of those cobwebs. I expect budget to continue to reinforce that notion, and hopefully that should reflect in foreign investors wanting to come back to India, and that should reflect in the currency over a period of time. At least it should not slide at the pace it has slid.
What can the budget do? What do you expect from the budget to prop up the currency?
Well, one is that the fiscal consolidation has to continue, so people have to believe the story that India will continue down the path of fiscal consolidation. I think they have to do a lot more in terms of ensuring that the share of manufacturing in our economy continues to grow, that MSMEs, the small enterprises, are supported much more than what has been done in the past. Government needs to continue to support manufacturing in terms of doing something about some very specific schemes for some of the sectors of the economy. end of the day, we want to come out of the mid-income trap. We need to invest a lot on R&D and creating global product firms. We're still far away from it. I think the time is slipping by, and the amount of money which government has to commit to invest has to be many times more than what they have done till now. So let's see what the budget is able to accomplish.
And Amitabh, what's fair value for the Indian rupee? And do you see the RBI under pressure to actually support it? It's done something, but it's not enough to reverse.
So RBI's stance has been that we don't intervene in the foreign markets. We let the rupee do its job. The only thing when we come and intervene is when there are sudden spikes which happen. So they are saying that we are not trying to aim a range. We are not trying to have a certain number in mind. But yes, if the spikes are there, we do support the currency so that the exporters and the importers.
What's fair value?
My mind is that I think India has seen a pretty sharp depreciation over the last 12 to 18 months. With a lot of the other things which are happening and what are happening around the world, hopefully the rupee should stabilize in this range as we go forward.
That's Axis Bank CEO Amitabh Chaudhry there speaking with Bloomberg's Haslinda Amin in Davos. Let's take a look at our Asia benchmarks tracking at the moment. We did, of course, just get that 20-year JGB bond auction. It was a little bit weaker than the 12-month average suggested, but certainly not too bad. The big cover ratio 3.19, lower than the 4.1 we saw at the last auction. MSCI Asia Pacific, though, off by 0.5%. The Nikkei off by 1%. The Kospi still doing pretty well, that rally rolling on, but suffice to say we're seeing broad-based risk-off as this threat from President Trump towards Europe about trade over Greenland not abating just yet. We have more to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. So let's take a look at our markets are tracking at the moment. Broadly a risk-off sentiment, the one exception being the Kospi, where the rally just rolls on, although slightly more muted than in the past. We're better by 1/3 of 1% there, but most of the other markets in weaker territory. Got to talk about the 20-year government bond auction in Japan. We were waiting for that one. As expected, the demand was a bit weaker than the 12-month average. Bid cover ratio 3.19. That's compared with 4.1 at the last auction and a 12-month average of 3.34. And of course, it comes on a day where the Prime Minister, Takaichi, officially announced that, yes, she's dissolving Parliament, there's going to be an election, and the big day will be February the 8th. Now, the reason for a lot of that risk-off sentiment is because of this. Europe weighing how to respond to President Trump's latest threats over Greenland. Some investors speculate the bloc could sell US assets equivalent to trillions of dollars in bonds and stocks to push back against his renewed tariff war. Most strategists, though, see that as unlikely since the bulk is held by private funds, and such a move would also hurt Europe. US assets held within the EU amount to more than $10 trillion. That's according to US Treasury data, with more in the UK and Norway. Joining us now is Mitul Kotecha, head of FX and EM Macro Strategy Asia at Barclays. Mitul, thanks so much for joining us today. I just want to get your sense of where you think this disagreement between the US and Europe is heading. How do you see it playing out over the next few days? Do you think President Trump is going to blink?
It's a tough one. There is obviously the focus on whether President Trump does back down. It looks like Europe is putting together a very significant package of retaliatory measures. But at the same time, the comments coming out from European officials sound also conciliatory. And I think negotiation first and use of these measures afterwards, if negotiations don't work, seem to be the way this is heading. So I don't think anyone in Europe sounds like they want to get into a tariff escalation process here, but clearly they are fighting back in a way with these potential measures that could be announced. So I think next few days, it's likely we're going to see more and more discussions and to see whether some sort of compromise can be made. Clearly, at this stage, President Trump seems to be doubling down, so it doesn't seem to be any sense that the US side is backing down, and as we've seen with other official comments. So again, it's early days, but I don't think it's anyone's interest for this to escalate much further.
Yeah, well, markets certainly don't like this. And one thing that we saw way back in April last year with the Liberation Day tariffs, President Trump does sometimes listen to markets. And we heard from the Deutsche Bank global currency chief. He was openly talking about weaponizing capital. Do you see this as a potential outcome here, or is that a step too far?
Well, it's I think practically quite difficult to do that, because when we talk about $10 trillion plus of European investments in the US, it's not that suddenly you can just see these investments reverse very quickly. A lot of that is retail investments, a lot of institutional investor flows, some of it official flows. So, to get that reversal and to use that as a threat, I think is quite difficult. But obviously, Europe has a number of tariff measures and other measures it can do. Obviously, it can tighten the screws on US technology companies, etc. So there's still a lot of ammunition that Europe has, but I think a massive withdrawal of capital could only really happen if sentiment for the US becomes so negative, and if the situation deteriorates to such a point where investors become very, very worried about the US economy, US policy, etc., that you suddenly go back to, as you mentioned, Liberation Day, where you saw a big outflow of capital early last year. But again, look what happened. That capital left quickly and returned quickly as well. And I think for us, the bigger question is how much of this flow or outflow is going to be hedged. If we do see a reversal of flows, it could hurt the dollar. If hedge ratios increase into US assets from European investors, that could also potentially cap the dollar as well.
Yeah, well, to your point, we have seen dollar weakness and, relatively speaking, strength in the euro, or resilience at least, let's call it. Why is that? Is the euro being seen as a beacon of stability at the moment, or are we seeing some of those capital outflows? Are we seeing assets being repatriated to Europe ahead of the standoff potentially getting worse?
Well, I think it's probably early days to say a lot of this money is being repatriated, but clearly that remains a risk. I think euro continues to be fairly resilient, even though the data is a little bit weaker. More recently, Europe continues to benefit from a robust current account position, and the fact that clearly, as you mentioned, a lot of that money is recycled into the US. It could potentially be the case that some of that money is not being recycled at this point. There could be some caution about investing in the US, and that clearly could be helping the euro at this stage. So unlike expectations that the euro would be under pressure on the back of potential US tariffs, as you mentioned, the euro has found some resilience here. The question, I guess, is if these tariffs do get implemented and start hurting US or European growth, how much of that resilience in the euro can continue?
Normally, in a situation like this, we might see money heading towards traditional havens. But, the US dollar, the Japanese yen, well, they're both pretty weak at the moment. The Swiss franc seems to be holding up okay. But apart from that, is there any currency on the planet at the moment that you would call a haven?
That's a good question. As you mentioned, the yen historically has been seen as a safe haven and acts like a safe haven in the past. But for now, you've got other conflicting forces, a lot of idiosyncratic factors. For example, in Japan, obviously, upcoming elections, concerns about the fiscal deficit, obviously the sell-off we're seeing on the longer end of the Japanese JGB curve. So again, it's not clear that the yen is an obvious safe haven here. We're actually long dollar yen in our view. We still see potential upside risk for dollar yen from here, despite some of this intensification of risk. But look, if risk aversion really worsens, we see a major blow up in risk appetite, undoubtedly the yen would benefit in that environment. Swissy also, as you mentioned, is holding up, and Swiss franc would clearly be one of the bigger safe haven currencies in any sort of risk blow up. But there's not many currencies in this environment that would benefit. Historically, the dollar has been a beneficiary, but if a lot of this pressure is emanating from the US, it's not clear the dollar would rally on the back of any blow up in risk appetite.
In terms of the dollar as well, I'm wondering if you can help us explain some of the price action that we're seeing in gold, because, of course, gold is priced in US dollars. To what degree do you think the gold rally is, descriptive of a loss of faith in the greenback?
Well, there is a gradual de-dollarization taking place, and we've seen this all the way back from the initial tariffs that were implemented in 2018 and some of the sanctions on foreign countries, foreign officials, and generally a realization that there was a heavy exposure to US assets. But it's been very, very gradual. Gold, though, is clearly a safe haven asset. It's seen to be benefiting in an environment of extreme policy uncertainty, which arguably we're in now. It's also a good inflationary hedge. Clearly, if there are worries that central banks are going to keep policy easy, and obviously uncertainty around the Fed has probably acted as another factor driving gold higher. And clearly the latest worries about intentions over Greenland are helping. So gold, which has been on a very, very significant bull run over the last year or so, continues to benefit, hitting record highs, and seems unlikely at this stage of any turnaround in the environment that we're in.
Mitul, this is a fringe question that does come up from time to time in situations like this, but do you feel like the status of the US dollar as reserve currency might be getting a few more questions asked about it?
I think questions have been asked for a while about the dollar as a reserve currency, but I wouldn't overplay this either. The dollar has held up very well as a reserve currency. We don't see the sort of liquidity that US markets, in particular US bond markets, hold compared to elsewhere. And, it's clear that the US is still a major reserve currency, even if its share of reserves is gradually declining. It's still a huge trade-oriented currency. As you mentioned as well, most commodities are still valued in the dollar. So again, there are questions, and there's probably a gradual de-dollarization, a gradual decline in the dollar as a reserve currency, but it's a very, very, very slow process. I don't think suddenly the dollar's going to fall out of bed anytime soon.
All right, Mitul Kotecha of Barclays is sticking around because when we come back, we're going to talk more about the Japanese markets as Prime Minister Sanae Takaichi calls that early election. This is Bloomberg. Let's take a look at how Indonesia's currency, the rupiah, is performing at the moment. The short answer is not well. It's hit the lowest level on record, in fact. We talk about President Trump and Fed independence. Well, Indonesia says, hold my beer. President Prabowo Subianto is nominated as nephew for a Bank of Indonesia deputy governor position. This is sparking serious concerns about the potential erosion of central bank independence, and we're seeing that illustrated rather vividly in these currency moves at the moment. Mitul Kotecha from Barclays is back with us now. Mitul, we've heard also from Bank Indonesia its job is to defend the stability of the currency, but in this case, does the message really need to come from Bank Indonesia, or does it need to come from President Prabowo maybe rethinking this move?
Well, at the moment, clearly, as you said, the rupiah is under pressure, and everyone is watching the 17,000 level. In the past, Bank Indonesia has been able to defend the rupiah fairly well if it needs to via its triple interventions, NDF, DNDF and spot interventions, and still has ammunition to do that, although there are a number of DNDF maturities this week. And clearly, look, the messaging markets are focusing on the fiscal picture in Indonesia and what this means. As you also allude to, there's questions on BI as well, but sentiment has worsened in this respect. But again, we don't think the rupiah is going to slide from here. And as I mentioned, there could still be a lot of defense around this 17,000 level. But we will be watching for fiscal developments. Only recently did we hear that the deficit now is close to 3% of GDP. We're not expecting a shift in the target or a sustained breach of this level, but it does obviously send signals that there has been some deterioration on the fiscal front. So I think this is, again, worth watching. And clearly, sentiment for the rupiah will also depend on that. On the other hand, look, Indonesia has already seen a rapid outflow of foreign investors from the bond market in recent years. So the foreign share of bond holdings is already quite low. So in that sense, you're probably not going to see a huge amount of pressure coming from foreign outflows on the bond market.
Yeah, to your point, I mean, given the broader macro story around Indonesia at the moment, how likely is it that we could see a very rapid reversal of today's decline? Could it go back up again as quickly as it sank?
It certainly can. And look, I think, as you said, the global environment is still very mixed. I think Asian markets are trading very idiosyncratically at the moment. If we do start to see some better news on the fiscal front, if there's some improvement in terms of overall foreign confidence towards that fiscal credibility, I think this will be very, very important. Of course, obviously there'll be focus on Bank Indonesia. There's a policy decision this week. We don't expect BI to ease policy given the weakness in the currency, but it will be very important to see what Bank Indonesia tells us this week about its policy stance and where it sees policy going forward and the outlook there. And I think the investors will focus on that next.
Yeah, well, the rupee are not the only weak currency in Asia right now. There are a number of them. But I want to focus on the yen, which you made some remarks about a little bit earlier in our conversation. It did briefly pass through 158 again today. Where's the floor for the yen?
It's a hard one. Look, we've been long dollar yen for a while, and we do think that any sort of pullback in dollar yen is going to be fairly shallow. We're targeting 160 on our trade idea. I think there is risks of intervention as we move towards that level. But what we found in the past is when there has been intervention, it has provided a cap for some period of time, but that cap has generally been broken. So it could at least prevent a sharper slide in the yen if there is worsening confidence towards the fiscal front. Obviously, the election will be very important on that front, and to see whether Takaichi, if she does manage to get a coalition majority, moves towards increased fiscal, especially if there's pressure on defense spending. But on the other hand, look, in this environment, if we do see risk aversion intensify, that could help the yen. If we see, again, the terms of trade picture deteriorate for Japan, of course, if energy prices are to go up, that could be a negative for the yen. So the yen in this environment has kind of a mixed reaction. We're still biased for a weaker yen overall. But again, 160 is going to be a very, very big level.
Yeah, we've seen yields sliding across the curve in Japan, but typically weak yields or high yields might mean a stronger currency. Why are we seeing that correlation breaking down at the moment?
Well, look, I think this time round it's the cause of the move higher in yield. It's not necessarily because there is positive implications for the economy or markets see this as a positive sign that growth is strengthening. And the fact that the curve itself is steepening also highlights the fact that there is worries on the fiscal front. So the fact that it is fiscal worries rather than anything else that's driving this move in the yield, at the long end of the yield curve, is a reason why the yen is not benefiting in this environment. And look, from the Bank of Japan perspective, we're looking for hikes in July and December, but real rates in Japan are still very low. We'll be watching the Tankan surveys ahead of July. We're watching the Shunto wage round in April for further direction. But again, a less rapid tightening from the Bank of Japan also potentially suggests further pressure on the long end of the curve if these fiscal concerns continue to intensify. And that could also weigh on the Japanese yen, given that breakdown in the correlation, as you mentioned.
Well, let's throw another variable in the mix as well, which is this February 8 election. And, if you'd asked a month ago, you'd say Sanai Takaichi was a lock to win it. But since then, a new opposition centrist party has formed. Is that changing your calculus at all about the potential outcomes here? And, of course, elections don't always go as we might have predicted. And how could that change the picture?
That's right. It does change the dynamic somewhat. Takaichi's polling is still very high, and in that sense, she's still quite popular with the electorate, and that could help drive the LDP to a fairly strong position in the election. But as you said, the opposition has coalesced, and there is a stronger opposition in that sense, and they could do well if they coalesce around one candidate and win an outright majority in the lower house election. So it's by no means guaranteed that Takaichi and the LDP will win the election in lower house, given the opposition that has come together. And I think we'll be watching very closely. But like I said, the popularity of Takaichi is still very high. So it still seems like she's the favorite to come back. But whether we will see her and the LDP coming with a majority in their coalition is another question.
We have, of course, we're approaching thresholds where we might normally see intervention, just cycling back to your earlier point. Do you anticipate that's something we're going to see in the coming days, particularly if the yen reaches that level you described, 160?
I think if we get to 160 or above, the chances of intervention will be sharply higher. Again, the jawboning has continued in recent weeks, and we've obviously seen intervention verbally. That normally, the more aggressive that gets, the bigger the sign that we'll actually see actual intervention. But again, at these levels, perhaps, where we are now, around 158, the risk is less. I think as we get to 160, we will expect to see a much, much higher probability of intervention.
All right, Mitul Kotecha, head of FX and EM Macro Strategy Asia at Barclays. Thanks so much for joining us today with your analysis. Well, Japan's snap election, also a hot topic at the World Economic Forum in Davos. The CEO of Japanese shipping giant Mitsui OSK told us what the move could mean for the economy and the Bank of Japan.
If she will dramatically win, then her aggressive fiscal policy should continue, and in theory, it means that the weak yen will also continue. So.
Do you think the BOJ should intervene, raise rates earlier than anticipated to at least help provide some support for the currency?
Yeah. It depends on that to support the currency is that the government job in Japan. Therefore, it's very difficult. So it's a priority issue in the government.
And of course, companies looking at BOJ movements. When do you think the BOJ will raise rates? Might it happen in April?
Yeah. Once or twice in this year, they may. Yeah, the 0.75% is still very, very low compared to the 3% inflation rate as of today. So therefore, it is very natural that I expect a series of interest increase by BOJ.
Talk to us about the kind of disruption that shipping companies are undergoing right now. Do you expect that to accelerate in 2026?
Yeah, 2025 was a very, very difficult year for us. But particularly for the second half of the 25, we observed that the situation was gradually stabilizing. So that at the moment, our sentiment is relatively optimistic about the future in 2026. Still, lots of things are happening, particularly for the Middle East situation and Ukraine situations, and also that lots of the trade tensions between U.S. and other countries. But so far, that we can adjust ourselves.
There are global trade choke points, and the Strait of Hormuz is one of them. What's your own reading? Is the risk rising or easing at this stage?
We cannot ignore the risk. At the moment, the all trade passing through Hormuz Strait is okay. That we are managing that so many vessels, particularly for tankers and LNG carriers. It's very important for the global business. Of course, we have some concern about the political situation in Iran and the action of the U.S., Israel, etc. So far, it should be all right.
People talk about the possibility of a regime change in Iran. Would that encourage you to invest more? What would it take for you to do that?
Yeah, very difficult question, but the regime change cannot happen overnight, and it will probably create a very confused period, 3 years, 5 years, or even 10 years. Therefore, to be honest, I do not like that dramatic change at the moment.
Mitsui OSK Lines CEO Takaichi Hashimoto with Bloomberg's Haslinda Amin there in Davos. Let's take a look at how FX in Asia is performing at the moment, particularly the Indonesian Rupiah, which has hit a record low. There you see it, the second one down from the top of the screen. It touched 17,000 briefly before recovering off that. Now, the reason for the steep decline there, the President Prabowo has nominated his nephew as a Bank of Indonesia deputy governor. He is one of 3 nominees, but certainly investors didn't like this, rather apprehensive about implications for independence of the central bank, which, by the way, has a rate decision tomorrow, expected to stay on hold at 4.75%. And we also had the Japan 20-year government bond auction. Demand weaker than expected. As expected, the bid-to-cover ratio 3.19. That compares with 4.1 at the last auction, but yields in Japan rising across the curve. Coming up, as South Korea's stock market rally shows no signs of slowing, the Korea Exchange CEO tells us exclusively what's driving sentiment. This is Bloomberg. Welcome back. You're watching Insights. Here's a quick look at where markets stand. It is a mostly risk-off day across the Asia-Pacific. We've got the Nikkei off by 1.25% now. We did hear from the Japanese Prime Minister Sanae Takaichi earlier, announcing, as expected, Japan's going to go to the polls on February the 8th. She is banking on increasing her mandate, but we're seeing yields rising across the curve in Japan on an expectation that there's going to be a lot more government spending and perhaps a reduction to 0 of sales tax on food as well. The yen briefly sank through 158. It's back above that level now. But we are seeing some spots of green on the screen. And if you take a look there at the Kospi, well, it was weaker earlier in the day, but not even all of this disagreement over Greenland and tariff threats on Europe, which is weighing on the market, is derailing the Kospi. The Kospi's up 90% in the past year. It's sector agnostic as well, but we're seeing particularly that tech theme staying pretty strong, better by 0.25% right now. Well, the CEO of Korea Exchange is confident that this world-beating rally in South Korean stocks could extend as the nation presses ahead with efforts to improve shareholder returns and lure global capital. Speaking exclusively to Bloomberg, Jong Yun-bo also shared where he sees the benchmark Kospi index heading next.
I think the Kospi can extend beyond 5,000 and towards 6,000. Since the year before last, we have made efforts to increase shareholder returns through various programs, which have been supported by the government through policies and legislative revisions. Recently, South Korea's main industries, such as chip, defense, and shipbuilding, have been more competitive, which appears to have led to a new value up for the Korean stock market. It's nearing 5,000, but I think beyond that, even 6,000 is possible.
Now let's talk about trading hour extension. So Korea Exchange said this week that it's going to extend trading hours to 24 starting the end of 2027, and it's going to introduce 12-hour trading starting this June. Why does Korea Exchange have to pursue this extension of trading hours?
In light of these global trends and also to attract foreign investors, I believe expanding trading hours is inevitable. While monitoring the transition to 24-hour trading in the US this year, we believe we should move to a 24-hour trading system ourselves by at least the end of next year. Doing so would help attract overseas investors and ensure greater alignment with global market standards. As a transition, we plan to start 12-hour trading from June.
The won's weakness has been a big concern for South Korean authority, and once South Korean stock become a lot more attractive than now and have retail investors come back to the domestic market, do you think that can help stop won's weakness?
I think it would absolutely help. From a macroeconomic perspective, despite Korea running a sizable current account surplus, I believe the fundamental reason the won continues to weaken lies in the capital account. The first factor is the outflow of foreign currency driven by corporate overseas investment. The second is capital outflows stemming from domestic investors' investments in overseas assets. Together, these flows have been a key driver of the weakness in the won. In that context, the impact of portfolio investment on the exchange rate, often exemplified by so-called global ant investors, could begin to normalize as domestic investors return to the local market, and more importantly, as foreign investors increase their investment in Korea. I believe that process could serve as a catalyst for stabilizing the currency exchange rate.
When you said a few years, South Korea will be able to get an upgrade to the DM index with the MSCI, and how soon, a few years, do you mean?
The president aims to join the Developed Market League within his tenure, so that appears to be the final target that South Korea should pursue. It might take a few years, as it takes 1 or 2 years before the final reclassification is determined after joining the watch list first. Even if we start the process right now, the procedure will take several years.
And there are also concerns that the upgrade to the DM index would actually trigger funds outflows. What's your thoughts about these concerns that the upgrade may not be necessarily a good thing for the South Korean stock market?
Fundamentally, global capital is far larger than domestic capital. It's so large, the two are hardly comparable. If Korea is reclassified from an emerging market to a developed market, there will be mandatory allocation requirements for global capital. Therefore, I believe the inflow of capital will be substantially greater than the outflow.
Let's talk about some of the issues related to Korea discounts. So one of the priorities that the Korea Exchange have is delisting the so-called zombie firms in market and accelerating the delisting process. Why is this important to resolve Korea discounts?
About 2,800 companies are listed in South Korea. In the US, about 5,500 companies are listed on the New York Stock Exchange and the Nasdaq. The US GDP is about 15 times bigger than South Korea, while the market capitalization is 30 times larger. But the number of listed firms is only 2 times bigger. If you do the math, the market cap of individual firms in South Korea is about 1/15. In that sense, we think too many companies are listed in South Korea. In the future, these zombie firms must be forced out quickly to restore market trust. These unprofitable companies are easy targets of stock price manipulations and other unfair trades. To enhance confidence in our domestic stock market, we should do speedy work on rooting out zombie firms.
That's Korean Exchange CEO Jong-Yun Bo speaking exclusively with Bloomberg's Yuk-Yong Lee in Seoul. Staying in Seoul, we're watching shares of Hyundai Motor today. They're continuing to climb. They've added gains of about 60% so far this year. Let's get to our Asia Tech correspondent, Annabelle Drewlers now. So, Belle, tell us about what's driving this rally in Hyundai.
Yeah, well, it's really been a stellar run for the company, really kicking off at the beginning of the year. But essentially, part of it is being driven by these upgrades we're getting by analysts and really just sort of, I guess, catching up to the huge surge that we've seen in the stock, because you had, for instance, HSBC raising their price target to 580,000 won a piece. That was up from 320,000 won. Mirai Asset Securities is another. They've raised theirs to 520,000 won. It had earlier been at 360,000 won. So it has been, as I said, a very strong start to the year. The stock has gained around 60%, and it's also been interesting in the context of CES that took place, because one of the subsidiaries of Hyundai Motor, that's Boston Dynamics, they actually unveiled the Atlas humanoid robot at the event and certainly caught a lot of attention from people. So that is one of the key factors, just that general interest in the embodied AI operations of the business. Maybe there'd been a bit of a perception in the past that perhaps Hyundai Motor could have been at risk of falling behind or not keeping pace with cutting-edge technology. That is the Atlas robot there you're seeing from Boston Dynamics. Again, as I said, got a lot of attention at that event. But the fears that Hyundai Motor could have been a little bit behind the curve seem to have dissipated, and that is really what's prompted that big rally, and investors as well, and analysts, to turn more positive on the earnings outlook too.
Well, let's talk about Korea's approach to developing AI tools as well. The government's got a rather novel approach when it comes to developing new models. Got something to do with Squid Games. Do tell us more.
Yeah, exactly. It's really quite the story that we have on this one, and a lot of detail to it. But yes, as you said, it does have that reference to Squid Game, the very well-known Netflix survival drama, of course. But essentially, what the South Korean government is trying to do here at a headline level is to find the next homegrown AI champion, and the way they're going about that is a pretty novel approach, because they're sponsoring the competition, but it's a competition that was launched in August of last year, is expected to run for at least a year, and it's different teams that are essentially competing to have or to build the best AI model. They really want to get Korea on a par with global leaders like ChatGPT, for instance, from OpenAI. So the format is what's really grabbing a lot of attention here, because it's being dubbed the AI Squid Game, but essentially it follows these elimination rounds. So every 6 months, the team's AI foundation models face scrutiny, essentially examination, and then they're also eliminated. So the latest round of eliminations took place just in the last few days, and a unit of Naver was ousted. It was actually criticised for using foreign technology. That's one of the big pushes of the Korean government in this, is to have homegrown technology. They also dismissed a subsidiary of NCSoft. That was actually the sole one that was being run by a female. Who does remain in the running, though, it's actually subsidiaries of LG SK Group. There's also an AI startup, Upstage, but the two winners are essentially expected to be announced at the beginning of 2027, so in a year's time from now. So a couple more eliminations to go.
All right, Asia Tech correspondent Annabelle Drewell is there. Thank you. Let's get you to a headline that we seem to dust off every few hours or so. Look what's at another record. It's spot gold hitting $4,690. There you see on the left of the screen part of the reason for this impressive rally in gold prices. President Trump, of course, threatening tariffs on Europe for failing to cooperate, in his view, on selling Greenland to the United States. Europe showing no interest at all in backing down. Emmanuel Macron would like the European Union to reach for one of its most powerful tools in this dispute. That would be the anti-coercion instrument. Germany, though, showing no sign of interest in that. However, a lot of tension at the moment around the situation in Greenland, and spot gold catching a tailwind off the back of it. 4,700 now in sight. So you got the president there departing Palm Beach International Airport. He is on his way to the White House. We have plenty more ahead. This is Bloomberg.
We have more money being invested in our country than any country in history. As you know, the Secretary of the Interior, Doug Burgum, who's with me right now, has a lot to report. I don't know if you want to say a couple of words, Doug, but you might want to say how well we're doing as a country.
Well, with President Trump's leadership, we've got inflation coming down, we've got investment going up, we've got taxes going down, we've got energy prices down. Everything is aligned for us to have a banner year in 2026. And the interest.
President Macron saying he will not join the border meeting.
Oh, did he say that? Well, nobody wants him because he's going to be out of office very soon. So, that's all right. What I'll do is, if they feel like Costo, I'll put a 200% tariff on his wines and champagnes, and he'll join. But he doesn't have to join. If he said that, you're probably giving it to me a little bit differently. But if he actually did say that, but as you know, he's going to be out of office in a few months.
Did you invite President Putin to join the...
Yes, he's one of the people. These are world leaders, and the answer is yes.
Mr. President, how do you feel about the first year of your second term?
Amazing. Tomorrow is the first year. Think of it, 1 year. I don't think there's been a term like it. I don't think any president has had a better first year than we've had in terms of success. Again, we've taken our country from a failure with open borders, no business, everything going badly, terrific inflation, the highest inflation in history, prices that are through the roof. And we brought prices down. We have very little inflation. We have a great economy. And the prices are coming down still further. But I inherited a mess, and now we have the hottest country anywhere in the world.
Mr. President, do you think that you had any influence on the Giants signing a deal with Coach Harbaugh? How do you think he'll do in New York?
I don't know, but they got a great coach. I like the coach. I like his brother. They came up to see me about 3 months ago. They came up to see me in the White House. Did you know that?
Yes, I did.
With the mother and father, because the mother likes me and the father likes me, and I think they like me. And he's a great coach, and he's going to do well with the Giants, just like his brother does so well. They got something very special in their blood. And I'm happy for the Giants. They got a great coach. It's nice that you ask. I put out a strong word, hire Coach Harbaugh.
President, you tell us on the Fed, will you make a decision before Davos?
Yeah, I know who I want.
You know who you want?
In the Fed.
When will you make a decision?
I'll announce it sometime, but I know who I want.
Thank you. You said securing the Arctic from Russian threats is important to you. Why are you upset about NATO allies thinking that, more seriously in Greenland by holding military exercises?
Well, that wasn't a military. They sent a few people. And they say they sent them not for me, but to guard against Russia. But, NATO's been warning Denmark for about 20 years now, longer than that, 25 years. They've been warning Denmark about the Russian threat. And it's not only Russia, it's also China. So we'll see what happens. But let's put it this way. It's going to be a very interesting Davos. Goodbye, everybody. Have a good flight. Thank you.
Thanks, President.
It's President Trump there at Palm Beach International Airport. He's getting on a plane en route back to the White House. But as he said, he will be heading to Davos, saying it's going to be a very interesting Davos. I'm sure it will. He says he also doesn't care about the Nobel Prize. He cares about saving lives. We have to have Greenland, and he doesn't think the EU will be pushing back too much on Greenland. He also made some remarks on the Fed, saying, I know who I want. No clues on who it is, though, nor when that announcement may be coming. Well, India and the United Arab Emirates are moving closer amid rising geopolitical challenges. The two nations have announced plans for a strategic defence partnership and a $3 billion gas deal. Prime Minister Narendra Modi and President Sheikh Mohammed bin Zayed also set a goal to double trade to $200 billion within 6 years. For more, we're joined from New Delhi by India government reporter Sudhi Ranjan Sen. So, Sudhi, from that very warm reception that Narendra Modi gave to MBZ, it looks like the two countries are getting pretty close. Can you talk us through the deals that got struck there?
Well, I mean, a raft of deals that have been kind of sealed yesterday, or the intent for that has been made clear yesterday during the visit. And primarily among them is the defense cooperation agreement, where the two sides are talking about closer defense ties. There is already very strong defense ties, but this takes it a little bit further to joint training, more exercises, co-production of equipment. Mind you, India is trying to expand its defense industry, although it hasn't made much progress in that, and therefore looking out for partners. Moving on, it's got a gas deal with the UAE, which makes UAE the second largest supplier of LNG to India. That is quite big, and also there is an intent and a commitment to invest a few $1 billion into an investment center, a special investment region that's very close to Prime Minister Modi, and that he has been pushing for the last decade and more. So both sides coming the relationship was very close, but it's getting even more closer. It's getting even more entangled with one another. And interestingly, there has been a lot of discussion on the India Middle East Europe economic corridor, although the war in Israel, the Gaza conflict has kind of put a stop to it, but India and UAE are looking to work up their end and keep things ready, to the extent that they're talking about a trade hub that is going to service Africa. So it's a rough, agreements all across sectors, if you look at it.
So what's driving this friendship? Because this sort of comes as a contrast, really, after news of a possible defence pact between Pakistan, Saudi Arabia and Turkey.
Well, one of the reasons is, of course, the United States, and it's the policies of the United States which is kind of creating a lot of concern across the world, and more so in India, which has not been able to get a trade deal, and relationship is souring at one end. So India is looking out for partners, and at the same point of time, it is also trying to kind of harden its relationship in the Gulf so that it can counter Pakistan, which it's which is kind of done these deals with Saudi Arabia, another Indian partner, but not as big as the United Arab Emirates. So all these factors, so to say, driving this collaboration between India and UAE.
Okay, Bloomberg's India government reporter Sudhir Ranjan Sen there. Let's take a look at Indonesian assets again, particularly the rupiah, which we have seen slide to a fresh record low. And this is, of course, on news that President Prabowo has nominated his nephew as a potential governor for Bank of Indonesia. And that's raised a number of concerns over independence for the central bank. So the rupiah sliding to record lows. However, the benchmark index not doing too badly, particularly considering the regional context at the moment, better by about 0.25%. Well, global funds could pull more than $2 billion from Indonesian shares if MSCI changes its index rules, raising fresh concerns about the inevitability of Southeast Asia's biggest stock market. Let's bring in senior Asia equities reporter now, Abhishek Vishnoi. Abhishek, tell us more about this.
Well, there is a review in the works, the results of which would be coming out by the on or before Jan 30th. And MSCI Inc. is reviewing whether the already possibly least accessible market among the major Asian markets would need to see its weighting getting lowered further. Indonesia, as per our analysis shows, is housing the most number of stocks with low free float. And there have been these concerns over the years that some of this is actually leading to some kind of manipulation in the market, causing accidents in the markets. And therefore, on behalf of institutional investors, MSCI is reviewing its methodology. Now, in terms of MSCI's review, there are several approaches that it has taken, and all the approaches are actually going towards Indonesian stocks commanding lower weighting. Now, this is going to further amplify the problem for a market which is already illiquid. And then when you look at this move in context of what's happening with, Prabowo's nephew being appointed to the central bank, Dhanantara Sovereign Wealth Fund, stoking concerns among some institutional investors, this essentially caps the valuation of the market. $2 billion is the outflow that, our reporting is showing can come from passive investors. And you can imagine what would happen if active investors stop being active in Indonesian market. So this is likely to reduce the size and the heft of Indonesia in global markets, maybe to a global pygmy, and makes those things that Jokowi had done, the Jokowi era, as a distant memory.
At the same time, we've got Citigroup downgrading European equities to neutral. This is due to worsening relations between the EU and Washington. Can you tell us a little bit more about that?
Yeah, so Citi has downgraded the continental European equities, which means largely Europe excluding UK. For the first time in over a year, they've downgraded the allocation to this region to neutral from overweight. And this brings Europe neck to neck with US, which was already a neutral in Citigroup's allocation. What this means is this US-Europe tensions are making sure that both these markets remain at neutral or at the index level weighting in anybody who's looking to allocate in global markets. And therefore, we have heard about Sell America. This seems like the budding steps towards ignore Europe and possibly look at regions where there is growth and there is money to be made, largely EM, and within EM because China commands a big part. So again, a bit more positive for China. Now, the concerns that Citigroup has underscored largely goes in the direction of earnings and valuations that will get weighed because of these tensions between US and Europe over Greenland. And this comes in the context of Europe being heavily overbought.
Okay. All right, Bloomberg senior Asia equities reporter Abhishek Vishnoi there. As we leave you, let's take a look at how Asian benchmarks are tracking at the moment. Broad-based risk-off sentiment across the board. We've got the Nikkei off by 1.25%. But that is it for Insights. Horizons Middle East and Africa are up next. This is Bloomberg.